How do you know if you are too overconfident when you're approaching a capital raise? If you haven't asked yourself that question, now is the actual time. Because all too often, I've mentioned this in previous videos that one of the biggest killers for a capital raise is overconfidence from the founder's perspective. Now, let me give you some of the warning signs that you're approaching it with too much confidence, right? And this is all of us. I've done this. Most people have done this in some stage, because you've got to remember, to get us to the stage where we're out there promoting our business, we're working on our baby 24/7. We become passionate about it. We wind ourselves up. We build up our momentum. We build up our passion. In our minds, we've solved all the problems that we're going to be facing going forward, right? This is typically how it works. And also we could be having great conversations with potential customers and all this sort of stuff. So we wind ourselves up, and effectively what happens is people get to this stage where they get overconfident. Now, let me go through some of the warning signs when people contact us and we can spot that someone's overconfident with their capital raise, and we see that as warning signs. So the first one is, and it said, this is effectively the journey from being overconfident to humbled. So the first one is when someone rings in, they're like, okay, now I only want to deal with investors that are looking to put in at 500K or more, right? Minimum check size. Right. And then best of all, not only do I only want to raise 500K minimums, right? And we want the money in the next 1 to 2 months. So for us, as soon as we hear that, we know that someone is either inexperienced with raising money or absolutely far overconfident with their own capital raise. Because firstly, if you only want to receive investment from investors that are looking to put 500K or more in, you are effectively wiping out 80 to 90% of the potential investors that can actually invest into your company, right? So that is the first challenge with that issue, when you say, okay, I only want 500K check sizes. Secondly, go and speak to founders who have raised capital and ask them, how long did it take you from start to finish your capital raise? Right now, in the media, you're going to hear people talking about certain things like, oh, it took a week, it took a month. It's all BS, right? Often what happens is people set up their capital raise for months and months and months in advance before they actually launch it, to make it look like it only took 1 to 2 months. But that's not the case. It often takes anywhere from 6 to 12 months to do it. And this is why we're always talking to people about, that awareness phase. Now, remember, the 3 stages of a buying process are: first is awareness, second is consideration, and then the third one is actually the decision-making part. When someone's in the overconfident mode, they expect it to go from, well, you heard about me, to now you should make a decision, right? And unfortunately, that's not how it works, right? The only companies that are able to achieve that is if you're putting out 100% year-on-year growth, or if you're achieving 10 to 20% revenue month-on-month growth, and you've got investors fighting to get in. And we're talking about the rare 1 to 2% of cases of companies that are able to achieve this from a growth metric standpoint. Then you can have a bit of a frenzy. In more than that, you'll have investors coming to you, approaching you, providing you with term sheets about what it looks like to participate, right? That is what hyper growth looks like from an investor's perspective. For every other company that's going through a capital raise, there's got to be a realistic process in your mind about what it is the experience is going to be like. So the first one is the unrealistic expectation that you want minimum check sizes of 500K. I know plenty of companies that have done incredibly well, where they've had some of the first investments from investors anywhere from 50K, 100K, 250K, etc. Because one of the biggest things we've learned is, whatever the first investment is from an investor, it doesn't mean that that's the only money. So what we've found is with investors, they often invest significantly more when they participate in follow-on rounds than what they do in the first one. Because we remember, they're often going from, I don't know you, I've never worked with you, I've never invested in you before, to you're going from unknown to known to investing into your company. And often that first investment is a keep me interested investment. So keep that in mind. Then the second one I mentioned is that it only I want to get our raise done within 2 months. Stats are against you on that one. I said, unless you're experiencing that hyper growth, right? The stats are, and I'm not talking about, downloads or anything like that. I'm talking about hyper growth from the revenue perspective, right? And just traction metrics that are off, looking like that, high and to the right? Then the other one is, okay, now the investors that are going to want to be interested, they must have money ready to go. Effectively, I said they're investors. That is what they do every single day. They're looking for opportunities to invest their capital, right? Your version of ready to go is very different to their version of ready to go. They can invest in whatever they want. You got to understand, like they're going to be working with anywhere from 50 to 30 other potential investment opportunities. Our job as founders is to bring them along for the journey with us and to make sure there's alignment with potentially what their thesis is for our space, and then our thesis for the space as well as founders, and then also our strategy on how we're actually approaching it and how we're going with growth. That's effectively what this dance is about. It's not, I'm amazing, you should be throwing money at me. It's not, okay, no, here is our thesis. Here's how we're approaching it. Here's what we've achieved to date. Right? This is the problem that we see that we're solving. And then they've got to have a similar perspective as well, as far as on the problem you're solving. And you've got to remember, if they're looking at investing to you, there's a high probability they've made money in a certain area related to your space beforehand, or they've been observing you for some time. Right? So it's just about that alignment. Now, then the other one is, it's like, okay, I only want smart money. So, well, you need to clearly define what your version of smart money is, because smart money comes in all ways and shapes of varieties and forms of what you think. It could be accountants that are looking to add value from the business structure perspective. It could be lawyers that are looking to add value from a legal perspective. It could be technology, specialists in technology that want to be investors, but then also want to assist you on the technology development path. What does smart money look like to you? Said, I've had smart money where said the shareholder adds substantial value on helping me understand the best ways to engage in investor relations, right? So that's important. And then the other one, said the other kind is like, I only want to speak to investors with cash just ready to come in. So the fundamental challenge with that sort of overconfidence mindset, if you want to break it all down, is it's just often they're approaching the investor with disrespect to start with. So my suggestion for every single founder is your journey from being overconfident to just being a confident founder, which is completely fine, right? Is have absolute respect for the investor. Have respect for their background, have respect for their experience, because often they've done a hell of a lot more than they've done a substantial amount in their own backgrounds and in their own experiences in their own lives, right? And then have respect for their own process that they want to go through for the decision-making part and how they want to do things. If they're a billionaire and only want to invest 100K and wants to invest 100K into you, so be it. Congratulations, you've got a new billionaire on your register, right? Where we've seen people get disappointed by that. It's like, no, that's fantastic, because for what they may want to invest $1 million in the next round or $5 million in the next round, right? This is welcome to the game of actually raising money and working with potential investors. So start off with respect for the kind of person that you're dealing with, right? That's super important. And understand that people want to add value in their own ways. And the biggest lesson for me is that it's not about, the best lesson I got from a shareholder was, how do I create that platform for my shareholders to engage with me? And that has been super important. So tips for this is from the key signs, the warning signs of being overconfident is unrealistic expectations about first investment, saying, minimum 500K check sizes. Firstly, expectations of how quickly you can raise within a 2 month, within a 1 to 2 month period, which is just unrealistic. And then that putting those demands at, of what you think the investor should be like in interacting with you. I said, you're starting out overconfident. So I said, start from the space of start from the space of respect for the potential investor you're having a conversation with. And remember, this game is run around alignment of thesis, and also them having understanding and grasping what your strategy is to achieve your goals, and also understanding what your perspective of the traction that you're receiving as well, and how that could translate into future opportunity. Hope that's helpful on your capital raising journey. Look forward to providing more shortly.